Hi, everyone. I'm Rick Bensignor. Today is Tuesday, April 21st, and welcome to the In the Know Trader Show here on StockCharts.com. Well, as I've said multiple times over the last several weeks, lots is going on in the markets. These are different times than we've seen in quite some time. Lots of volatility, big ranges. And as I speak, the S&P has plummeted to new lows. It is now down about 81 points, and it was down another 10 just a few minutes ago. So we are seeing some significant selling once again in the market, even after yesterday's big decline. A lot of that probably has to do with oil and what's going on there. So it's kind of a risk-off day across the board. Today, for our agenda, we'll do a quick markets overview. I'm going to do a new segment, which may not come every week, but we'll do something called Trader School, and we'll talk a few minutes about something that I'll try to educate you on a particular subject. Today, we're going to do it on shorting. A lot of people actually don't know what it is to short market or stock, so we will talk about that, and then we will review the energy sector given the spectacular decline in the price of crude oil that we've seen recently, but most especially yesterday. And in fact, for those of you who watched TV news or read the Wall Street Journal this morning or something, you will know that crude oil futures actually traded to, I think it was about minus $40 yesterday. Minus $40. We'll talk about what that means. We'll take a look at the USO ETF and then the XLE, the energy versus the S&P. So in other words, a relative performance chart of how energy is doing. XOP, which is the oil and gas ETF, and OIH, which is oil services. So we'll kind of take a look at what's going on across the energy space. In fact, maybe we'll even throw in there natural gas. I guess we should, because that is part of the energy space. So we will take a look at that too, and I will write myself a little note to look at that too. Good. So that's today's agenda. Now, to get, for those of you who like the way I look at the market, the S&P, the bond market, gold, etc., for key support and resistance levels, as well as, for instance, why a few days ago I told subscribers that the stock market would likely falter late last week. And obviously, we've had 2 significant days of sell-off since. You can sign up to become a subscriber at intheknowtrader.com/sign-up-1.html, or just go, that takes you directly to the sign up page, or just go to intheknowtrader.com and find the sign up tab. And you get 2 weeks to receive my notes that come out once a week. So you get 2 weeks to look it over and decide if you want to stay a client. And I can tell you that virtually everybody who signs up, in fact, I can only think of one person this entire year who, once they signed up, didn't continue. One person. And to contact me, Rick at intheknowtrader.com. That's the best way to get a hold of me. So let's move to some charts, and we'll do a quick look here. Let me just give you, this is a chart of the S&P. Subscribers will know my best case scenario for the S&P is above where we recently topped by a couple hundred points. I don't think we'd likely get lower than this green zone either. Somewhere, approaching that early April low. For more details, that's what you get as a subscriber. So that's that for the S&P. Here is just a quick look. This is the gold market on a monthly chart. So there's that 6-year rounding pattern, the breakout from these purple lines that measured up to $1,700, the green line. We got to about 1780. Let's see, what do we have? 1789 is the high of the move. And that is pretty darn close against these highs back here, right near 1800. So once gold made its all-time high at $1,924 for front month futures, back in 2011 and sold off. You had 3 highs at 1800. We have come back to test that. And now we're kind of, again, back to that longer term target of 1700. To me, as long as gold stays above 1662 for June futures, I think it's okay. Today's low actually was 1666. So we got just $4 away from what I deem to be pretty darn important support. We've come back right close to the $1,700 level. So in general, the uptrend is still intact, but we have hit some targets. So it wouldn't surprise me if we spend some time here. And just quickly, US, here, let me max this chart. There we go. US 10-year yield, so this is the TNX, continues to stall. In fact, if I switch this, I think the daily has, yeah, right up here, kind of 1, 2, 3, 4, almost 5 days in a row. We got into this, when I say 0.7s, I mean 0.7%. This, rates need to get above 0.78.5 or TNX 7.85. Think of it in those terms in order to have a chance to break to the upside. Otherwise, today is as low as they've been, basically 55 basis points. The low for the move was 40 basis points, and that's only during actual trading hours of the New York Stock Exchange. When the TNX is calculated, actually rates got a full 10 basis points lower. It happened overnight, so they actually got to just about 30 basis points in early March. So I was hoping to see a breakout to the upside. It has not occurred. We were in a trade that related to how the TNX would do. We got stopped out a few days back, and rates are still staying low, as there is still some flight to safety and overall concern of what's going on. Let's kind of take a look at what's going on here in crude oil. So crude has been under pressure. This is a daily continuation chart. So you can see if we go back, a year or more, we got up to, in the fall of 2018, crude got up to $77 a barrel, see 76.90. Within a week of that high, I was on Bloomberg TV stating that high would not only be a cyclical high, and a cyclical high normally would mean, let's say, for a year, but a secular high. I actually called that high to be the high in oil for the foreseeable future. And I got lots of pushback on that from people saying that oil's going to $90 and $100, et cetera, and gave all the reasons. And I cannot tell you that I foresaw a move to $0 or less than $0 like we saw yesterday. But I did think that was a good chance that we were going to get sub 40 oil. And from that move, we got to about 42.5, up to about 67. The spike up in January this year, here when the Iranians bombed the Iraqi base that the U.S. military was at, that was that spike up, and that was the last move higher before oil really sold off sharply. And then over the last month, most of the trading was between $20 and about $28 a barrel here, and then it just fell apart. And that is a function, and this is why if you're going to trade futures, you really have to understand what you're trading. This was a function, yesterday's absolute price to collapse was a function of the May contracts expiration, which takes place today for oil. And you can see that right now, if you're looking at this, the front month oil is trading here at this expires today at 518. That yesterday fell from a high of almost 1785. It actually went minus, and you say, how can it go minus? The exchange, when oil was trading about, I don't know, $6, $7, $8 yesterday, the exchange came out and said oil can trade negatively, and you try to understand what that means. Once you got down to $0 and broke under zero, you actually had to pay somebody to take your oil. Normally, you give somebody cash and they give you oil, right? You buy a product, you give money, they give you the product. What happened yesterday is that you actually had to pay somebody to take oil. And when you try to conceive what that means, it's because people had futures contracts um, that were expiring today with no interest in actually taking physical delivery of oil. And part of the reason this blew out the way it did to the downside is that there's nowhere to store oil. All the oil tanks are spoken for. There is no place to store oil in the country. And we are awash with oil. So in one way, you can say that there's a tremendous amount of supply. And of course, while business is now closed because of coronavirus, people are not driving. There's all this oil sitting that is not being used. And other than essentially heating our homes for those of us who heat homes with oil, so that's a lot of the northeast of the country, um, there's just no demand for oil. So we can understand why the price was falling, but to see it actually collapse to going negative, where you're actually paying somebody to take your oil, is something we've never seen before, and truly a function of the fact that oil was expiring today. Um, June oil, which as of tomorrow will be the front month futures contract, right now is trading at about $14. It's off $6.50 today. So even June oil is down 32% today, simply because it will become front month oil. And there's the same situation that there's just too much oil around. In fact, there are two Saudi oil tankers on their way to the US that should come within the first couple of weeks of May. They are headed for the Gulf states of Louisiana and Texas. And they have millions of barrels of oil on those two tankers too. So the market is now reflecting too that there's just nowhere to put oil. And that's why you saw oil actually trade negatively. It is a phenomena that I do not recall seeing in any other commodity. I know once or twice something traded to just beneath zero. It was like momentarily, but the fact that oil actually went down to minus 40 yesterday is beyond the wildest dreams of anybody. And of course, it's hurt many people's pockets. Because those people who had oil contracts were forced to sell out instead of having some value left. You know, if you buy something at 20 and you sell it at 19, you took a loss, but there's still value to what you sold. Here, people were forced to sell and actually take not just losses, but now you had to pay somebody to take the risk of taking that oil from you in a negative fashion. It's just a wild phenomena that hopefully we don't have to deal with too often in the future. But it's certain to say that right now, America is awash with oil. Brent crude, which is the global benchmark, so WTI, which we talk about here in the U.S., is the benchmark for U.S. oil. But anywhere else in the world, it's Brent oil crude futures that are traded, and that's still probably in the, let me see if I even have it on my quote board. Do I have Brent here? No, I don't, but I would still put it somewhere in the low 20s. So, I mean, there is value to oil. It's just not in America right now. So you will see gas prices go to go fill up your car, decline quite a bit too. However, nobody's driving anywhere, which is such a shame that we have this essential, well, almost call it like a tax break. When gasoline comes half the price of where it was a month ago, it's significant savings to people, but nobody's driving anywhere right now. So we can't really take advantage. You might as well go out and fill your cars up. Wait a few days so this actually trickles down to the retail level at the gas pumps, but might as well fill your cars up. But obviously most people are not driving anywhere, so we can't really take advantage of what's going on. Nonetheless, I would think for the foreseeable future, oil is going to stay at a low price, and we should reap some of those benefits. If you're in the oil industry, or if you're a bank in Texas that loans to the oil industry, you're in trouble. But otherwise, for the average American, the fact that your heating oil will be far less expensive, that your gasoline is far less expensive, is kind of a windfall for us. From a speculative point of view, I will tell you, I don't care if this doubles in price. Well, here, let's move on to, let's take a look at USO. All right, so we'll just do it from here. So here's the ETF that tracks the price of oil, but it does not track necessarily just the front month price of oil. So when USO was first developed as an ETF, it simply tracked the price of front month oil. And people in the industry and speculators eventually were able to figure out how to game the ETF, because the owners of the ETF didn't actually ever want to take delivery of oil. So every time they'd buy oil, for every dollar that came into the USO ETF, they had to own oil for it. But then as the oil contract would expire each month, they would have to sell out and roll to the next month. And people were gaming, knowing that they needed to sell out by expiration. So now they own multiple months worth of futures contracts of oil. They still own futures contracts, but instead of just being the front month, now they'll go out multiple months down the road. So this is not a perfect hedge. If you're long oil futures and you sell USO against it as a hedge, or if you're long USO and sell oil futures against it as a hedge, it is not a perfect hedge unless you truly understand which contracts are being owned within USO and you do those in the futures markets. Nonetheless, I don't care if this doubles in price from about the $3 from where it is now, and it might very well, but I will tell you that it's just simply not worth trading. And lots of people do trade it right now. I'm looking at my quote board. This thing has traded over 340 million shares today, which is a spectacular. I don't know what yesterday's was, but this thing never trades like that. And there's massive liquidation from people who own USO, who are just getting beaten up. And honestly, I don't know if this can go negative in price. Again, I can't even think of what that would be. In futures, I understand going negative. It's, again, not something you ever see, but I can conceptualize it. Shares going negative, I really can't. So I'm not sure this can go less than zero. I don't think it can, but I will say stay away. And I'm fully saying this, telling you that yes, this could double in price shortly. Is it worth taking the chance? No, it's not. Not in my world. There is clearly something going on in the markets, in the oil market, that is a huge dislocation compared to anything we've ever seen. And my advice is stay away. And yeah, if you miss a doubling, so be it. That's how I look at it, because you and I and nobody's going to know how to price oil and when this is a good buy. So even though I normally would use, I might trade off of 9s or 13s. Tomorrow is likely going to be a 9. I don't care. Not right now. To me, when I'm trying to help you as best I can and do what often I will tell you, like what I would do myself, I will tell you as my best professional opinion, regardless of the fact that, you could speculatively, maybe if you're lucky, time this right and buy it and make some money. It is simply not worth it. So it's also not something you would generally want to have in a retirement account. And the reason why you don't generally want to own any of the ETFs that track the futures markets is because of a function in the futures market called contango, which is generally that each month farther out on the calendar generally costs more than the front month. So for instance, the December gold futures are going to cost more than June gold futures. And this is basically with all commodities most of the time. Occasionally there's an issue where they go into backwardation where the front months are priced higher, but generally futures markets, the farther out you go, they tend to be priced higher. So any of these contracts, these ETFs that track futures contracts, generally are losing assets because each month they have to sell out of the month that's expiring and then replace it with a higher priced contract. So there's an automatic loss on the roll. So they've tried to adjust for this, but nonetheless, this is not something that you'd want to put into a long-term. This to me is a pure speculative play. And again, I've made it clear, I'll say it again, not something worth playing. And generally, I would stay away from any of the commodity type of ETFs into your retirement accounts. All right, let's take a look at XLE just on its own. So here is the XLE on a weekly chart. You can see here, if I draw, let's say, a trend line from that low to this low, right? So the major trend broke a couple months ago too. As far as, well, not major trend, the major support line broke. This has obviously been downward trending, but it's been choppy. 2020 has been another horrific year for energy, as it was last year relative to the S&P, and we're not even looking at it. I'll get to the relative chart in a second. But again, unless you really want to do some bottom fishing, and there are some people in the industry, notable people, who are doing some bottom fishing in energy. The one that comes to mind most notably is Lee Cooperman of Omega Advisors. You'll see him on CNBC frequency. He is known as smart money on the street. He's been a very successful hedge fund manager for many, many years. He got all his training at Goldman. He was a partner at Goldman, left and started his own hedge fund, and it's been very, very successful. He has said a few times this year that he's starting to look at energy. And so, there are some people who are, starting to bottom fish a sector that is incredibly cheap. But here, before I get to the relative chart, let me just change this one to be the relative chart. And I'm going to change the time frame, actually divided by. Okay, so I'm just going to take everything off this. So here is a weekly chart, and this is the total trading history of XLE divided by the SPY, the spiders. So from 1998 up until 2008, oil generally outperformed for 10 years. And then it was sideways for a few years. And then since, we can call it, I guess in here, since 2014, a massive underperformer. You've gotten crushed. And basically, if you're looking here at all-time history, you realize that, this has gone to the lowest level it's been since the ETF was created. Now, the S&P Energy Index has history before 1999 or 1998. I'm not sure exactly when this was. It looks like just about the beginning of 1999. So I don't know if this is an all-time low, but certainly in the last 20 plus years, energy has just been decimated. So it has been the one place in the market that you have absolutely been crushed and have made no money in terms relative to the S&P in over 20 years. Or you can say since these ETFs started trading, you are actually now down. Significantly in negative territory. So terrible, terrible performance, the one sector of the market not to have been in. But I will share with you something that I shared with some institutional clients, and that is this chart. Same chart, just on a monthly chart. And I was trying to see, is there anything to give me a sense that maybe energy could be bottoming? So here's that same line, what had the previous all-time low. Now we happen to be on a monthly basis, the month of, what are we in, April? So the month of March actually posted a 13. So possible downside exhaustion. Let's look at the other 13s that this has had in history. In 2002, gets an upside exhaustion signal, goes sideways for a few years before it broke out. That makes that a successful signal because it says it's a change of trend. So you went from uptrend to sideways, that's a change of trend. Next time it gets to 13 is in 2006. Goes sideways for a year or so. Okay, but again, it kind of told you when not to put the spread on, when not to buy energy versus S&P until it broke out to the upside. And here again in 2000, just about 2011, upside exhaustion of the trend. Even though the all-time high was made up here, this is saying trend exhaustion, and that obviously hardly ever went against you, just a little couple months, and it's been down since. Trend exhaustion signal here, sideways for a year. It's okay. It told you not to put it on then, and now you're getting another one. All right, so is this 13 worth looking at? And look, I said, let's look about in wave, and think about this in wave terms. The first wave down is from the high to here. That's wave one. This is using DeMark's automatic wave counting. So you may count differently, but this is all mathematical. Wave two is here. Wave three bottomed here. Wave four was up here. So I measured the height of wave one was from A to A prime. Take that same distance from B and you get B prime. That's where we hit last month, exactly there. So wave five exactly equals wave one, and we have a 13. That says to me, this is worth taking a look at. As bad as it is, and energy is going through horrific things now, I'm not sure news can get a heck of a lot worse. Now, this is a monthly chart, it's long-term, so it doesn't mean that right away you have to put something on, but it at least says to me that I can make a case for why to potentially, oh, I did not want to do that, but okay, I just erased my own chart with all that stuff. Here's XOP. So here's a weekly XOP. Any reason to fish and do some buying? Well, you've got a weekly 9 count, potentially a bottom deeply oversold. Maybe you nibble a little, but look, you're fighting trend here. And there's going to be, some significant resistance back up towards 80, but it's 42. There is room for the energy. Again, right now, I'm not sure you have to rush into it. It's getting the worst news it can, but well, that's not nice. My internet connection is unstable. And then the last chart we're going to look at is OIH, which is the oil service ETF. And so this, same thing, straight down. Here's your 200-week moving average, similar type of 9 count on the bottom on a weekly. So we are getting a little bounce, but you are fighting trend. The resistance level here is not quite the same, but I would say, look, here's the old low, here's the old high since breaking down. So anywhere in there, there's going to be lots of resistance, but those numbers are way, way higher. So other than risking the low, I don't see how, you can, if you were looking to buy this, you could potentially nibble against these lows, but otherwise you really have nothing else to lean on. So that's a look at the markets and more specifically the energy sector for this week. Thank you for tuning in. I am Rick Bensignor, and this has been In the Know Trader.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.